Okay, so you've sent over a really fascinating set of materials for us
Hmm.
to dig into this time.
Yeah.
Really gets into what the Fed's been up to lately, the kind of the overall picture of the U.S. economy right now,
Uh-huh.
and then, what it all means for us as investors,
Yeah.
how all this might impact our portfolios.
Right.
So I'm excited to kind of dive into this and really try to pull out the key insights from all these sources you've provided.
Absolutely. I think as we've gone through it, there's several key themes that have emerged.
Yeah.
The first one is there's definitely a lot of concern about the U.S. fiscal situation and particularly the debt.
Okay.
And then the Fed's recent interest rate cut back in September of 2024
Mm-hmm.
really begs the question of how does this compare to other periods in history?
Yeah.
So there's, obvious comparisons like 2007, 2008.
Oh, shit.
And then maybe the dot-com bubble period of 1999 to 2003.
Yep.
And then, you even go back further in history and you can look at things like the post-1981 period
Hmm.
or even the period leading into 1929.
Right.
And then finally, you've included some commentary on current valuations and potential investment strategies. So
Yeah.
our mission today is to connect all these dots and try to make sense of the Fed's recent actions within this broader context.
Okay, so let's unpack this, and maybe a good place to start is with this topic of the U.S. fiscal situation.
Right.
That sort of elephant in the room, the national debt, and this report really doesn't mince words right from the beginning. It highlights the concerns about the federal deficit
Right.
and how there seems to be a lack of appetite from either political party to actually do something about it.
Yeah, and the data really paints a pretty clear picture.
Yeah.
The Financial Times article you've included from October 7th of 2024 references a report from the Committee for a Responsible Federal Budget,
Huh.
and their projections are that the U.S. federal debt could rise by $7.5 trillion under a Trump administration,
Wow.
or $3.5 trillion under a Harris administration through 2035.
Yeah, and those are huge numbers,
They're
right?
massive.
And just to put that into context, the article reminds us that right now our national debt is about 99% of GDP.
Yeah.
Um, and GDP, for those who are not familiar, is really the total value of everything. Our economy produces all the goods and services,
Right.
and the Congressional Budget Office, CBO, projects that, if nothing changes, that could climb to 125% of GDP in the next 10 years.
Right.
And then if you layer on those presidential projections, we could be looking at 133% under Harris or 142% under Trump.
It's a very serious problem.
Yeah, and one thing that really stood out was the editorial from Bloomberg that you included,
Uh-huh.
and they raised this really important point that financial markets might start to question the U.S. government's ability to actually repay its debt
Right.
if this deficit issue isn't addressed.
Right. It may seem manageable, and then all of a sudden it's not.
Right, and then it's too late.
Right.
And so it really makes you think about how much leverage the Federal Reserve even has in this type of environment.
Right.
And the report quotes Milton Friedman, who said that, central banks can control a specific interest rate, like the Fed funds rate,
Right.
which is the rate that banks charge each other to borrow overnight, but they can't really control interest rates in general.
Right. And that's really the key insight from Friedman is that, the Fed can influence short-term borrowing costs, but long-term interest rates are determined by the market, people's perceptions of risk expectations about inflation,
Uh-huh.
and, the perceived, fiscal responsibility of the government.
So are we already seeing some early signs of this playing out, after the Fed cut rates in September 2024?
Yeah, potentially. The report highlights that the long-term Treasury ETF, TLT,
Uh,
which is basically a basket of long-term U.S. government bonds,
right.
has actually declined about 7% from its high back on September 17th.
Yeah. I mean, and the report does acknowledge that some might argue that this is just the market already pricing in the rate cut, as
Yeah.
widely anticipated.
Right, the markets are forward-looking,
Exactly.
and they often incorporate these expectations into asset prices.
Uh-huh.
But it does raise the question, are investors starting to become more concerned about these underlying fiscal challenges?
Right.
Which could
Yeah.
limit the Fed's ability to actually influence those longer-term rates.
Okay, so we've got these potential fiscal headwinds.
Right.
Let's maybe shift gears a little bit and talk about some of those historical comparisons that your sources provided.
Yeah.
And let's start with 2007, 2008.
Okay.
The time of the global financial crisis.
Huh?
The report mentions that George Gammon drew a parallel between October 2007 and October 2024,
Right.
and noted that the Fed began cutting rates in September of 2007
Right.
in response to those emerging concerns.
Yeah.
And what's really interesting if you look back at that time is how the stock market initially reacted.
Yeah.
The Wall Street Journal reported that after the Fed cut rates on September 19th, 2007,
Uh-huh.
the Dow Jones actually went up 2.5%
Right.
and kept rising for a few more weeks, peaking in mid-October.
Mm-hmm.
So it just goes to show that that first rate cut, can sometimes be met with some optimism.
Yeah. At least in the short term.
Right, exactly.
Yeah.
But we all know, of course, what happened, after that initial optimism wore off.
Right.
The report highlights, that major market downturn that happened between October 2007 and March 2009, despite the Fed, cutting rates even further throughout that whole period.
Right.
And it really just goes to show that, monetary policy alone can't always fix everything.
Right. Especially when there's these much deeper structural issues,
Exactly.
in the economy.
Yeah. And it's a really important lesson, I think, for today.
Right.
It's not as simple as just cutting rates and all the problems go away.
Exactly.
And some might argue that, the deflationary pressures back then,
Right.
and the whole housing market collapse were very specific to that time.
Mm-hmm.
But the report actually includes this really interesting quote from that same Wall Street Journal article from September of 2007,
Oh, wow.
where some economists were suggesting that the Fed's rate cut could actually lead to higher fixed-rate mortgages.
Interesting.
Down the line, if the bond market started to anticipate stronger growth or inflation as a result.
Wow.
So it's not always intuitive,
Right.
what the market reaction is going to be.
Right. And it really highlights these complex feedback loops,
Exactly.
between the Fed's actions and the market's expectations.
And it also ties into the author's argument that we could potentially see this scenario where we have asset deflation.
Right.
So, things like stocks and houses going down in value
Mm-hmm.
at the same time that we have this accelerating consumer price inflation.
Right. So everything's getting more expensive,
Right,
but
exactly.
your assets are going down.
Yeah. So it's not always, lower rates means everything goes up in price.
Right. It can be a much more nuanced situation.
Okay, so let's look at another historical period
Yeah.
that your sources bring up.
Yeah.
The dot-com bubble bursting, between 1999 and 2003.
Uh-huh.
And the report reminds us of this really dramatic decline of the NASDAQ 100 index after it peaked in March of 2000.
We're at the end of the tech bubble.
Exactly. And the Fed responded to this with, pretty aggressive rate cuts starting in January of 2001.
Right.
Trying to soften the blow,
Right.
to the economy. And it's interesting to remember that back then, some pretty prominent Keynesian economists like
Yeah.
Ben Bernanke and Paul Krugman
Right.
actually publicly said that they were in favor of a housing bubble
Wow.
as a way to stimulate the economy after the dot-com bust.
That's amazing.
It is. And what's really interesting from the report's analysis is that those rate cuts might have helped some parts of the economy, but they didn't really rescue the sector that had been at the heart of that bubble.
Right.
The technology, media, and telecom stocks,
Yeah.
the TMT stocks.
Right.
Those continued to go down significantly,
Interesting.
despite the lower interest rates.
So it wasn't a cure-all.
No, not at all. And the report also points out this really significant turning point for commodities
Yeah.
during this period.
Okay.
Notably, gold, which had been in a bear market for a long time, hit a major low in 2001
Right.
and then started this, pretty substantial climb.
Right. And it coincided with a broader shift in market leadership.
Uh-huh.
These high-flying tech stocks fell out of favor.
Right, the new economy stocks.
Right. And investors started to rotate into these more traditional old economy sectors.
Uh-huh.
Financials, real estate, commodities,
Yep.
precious metals.
Yeah, so maybe a flight to safety?
Yeah, potentially, or maybe a search for value.
Right, or both. Now, I know some of our listeners might be thinking, well, what about that big bull market that we saw after the energy crisis in the late 70s and early 80s?
Right.
When Volcker was at the Fed and they cut rates aggressively.
Right.
And the report does a really good job of addressing that.
Yeah.
So yeah, the Fed did start cutting rates back in the summer of 1981.
Right.
But the major U.S. equity bull market didn't actually start until late August of 1982.
Interesting. So over a year later.
Over a year later. Yeah, and what's even more interesting is that by that point,
Right.
short-term interest rates had already fallen over 50%
Wow.
from their peaks. And the stock market had actually kept going down for over a year
Right.
while rates were falling.
So it wasn't a direct correlation?
Not at all.
Wow.
And even more importantly, the report points out that, valuations were just dramatically different back in 1982 compared to where we are today.
Right.
Back then, stocks were really cheap. In real inflation-adjusted terms, they were no higher than they had been in the early 1900s.
Wow.
The price-to-sales ratio for the S&P 500 was around 0.5.
Okay.
Now, fast forward to today,
Mm-hmm.
and the S&P 500's price-to-sales ratio is around 2.9.
Wow, that's a huge difference.
It's a huge difference, right?
Yeah.
And so the report's argument is that back in 1982, that bull market really took off because everyone was anticipating the end of that severe recession.
Right.
Unemployment had hit a post-World War II high.
Mm-hmm.
That's a very different economic backdrop than what we're seeing today.
Right.
Unemployment is still pretty low.
Yeah.
So instead of this being like a 1982 buying opportunity,
Mm-hmm.
the report suggests that maybe this is a time to think about reducing exposure
Okay.
to those really popular stocks, the Magnificent Seven tech companies,
Yeah.
all that AI hype.
Yeah, when valuations are high, there's less margin for error,
Exactly.
if things turn south.
Okay, so let's move on to one last historical comparison. And it's a big one.
Yeah.
The 1927 to 1929 stock market bubble.
Right.
And the report draws some parallels between, the rally that we've seen since the lows back in October of 2022
Mm-hmm.
and that earlier period of speculation,
Right.
the Roaring Twenties.
Right.
It specifically talks about how some people have compared the Fed's recent rate cut to Benjamin Strong, who was the head of the New York Fed back then,
Right. Yeah.
and his decision to cut the discount rate in 1927.
Right. And the argument is that this loose monetary policy back then helped fuel that bubble.
Right, exactly.
Yeah.
And the report really digs into this argument from Peter Schmidt, who talks about Benjamin Strong's fatal conceit.
Right.
This idea that, central planners can actually manage the economy effectively.
Right.
And he brings up views from financial historians like Jim Grant and Adolph Miller,
Mm-hmm.
who suggest that Strong's actions,
Yeah.
particularly that 1927 rate cut,
Right.
which some believe was partly intended to help the Bank of England,
Yeah. Interesting.
actually played a role in setting the stage for the 1929 crash.
Wow.
So it's a pretty fascinating take.
Right.
But the report also presents this counter-argument
Okay.
that Strong's influence might be overstated
Right.
because that rate cut was actually pretty small,
Uh-huh.
and they reversed it fairly quickly.
Okay.
And it happened, pretty early on in that whole speculative period. So it's not a perfect comparison.
Right.
But the report does point out that things feel different today.
Right.
In 2024, speculation is everywhere.
Yeah, it's not just one or two sectors.
Right,
It
exactly.
seems to be much broader.
And there's a ton of liquidity in the system.
Yeah.
The report even quotes a note from BofA Global Investment Strategy
Okay.
saying that September 2024 was the biggest month of monetary easing since April of 2020.
Wow.
Back at the start of the pandemic.
Right.
And the report includes this really interesting chart that shows, a pretty close correlation between the growth of the global money supply
Right.
and the performance of the S&P 500.
Uh-huh.
And you can see, that the peak in global liquidity back in March of 2021
Right.
coincided with all that meme stock mania and this SPAC craze.
Right.
And then the low point in liquidity
Mm.
was right before the S&P bottomed in October of 2022.
Interesting.
So it really highlights, how important those monetary conditions are
Right.
for asset prices.
Yeah.
And just to bring it back to 1927,
Yeah.
the report reminds us that even back then,
Uh-huh.
during all that speculation,
Right.
the Dow Jones, in real inflation-adjusted terms, wasn't that much higher than it had been at the end of the 19th century.
Wow.
So it's always important to remember that.
Yeah, nominal prices don't tell the whole story.
Exactly. You got to look at the real value over time.
Right.
Okay, so we've talked about all these historical parallels.
Right.
Let's talk about what's going on right now. How are the current economic conditions comparing to what we're seeing in the markets? Right. And the report really highlights this divergence between the two.
Right. We hear a lot of talk about the strong economy.
Yeah.
From the Biden administration, Wall Street analysts.
Right. Everyone's optimistic.
Right.
But the report argues that if you look closer at the data,
Yeah.
the picture's not quite as rosy.
Right.
So nominal retail sales, they're up about 1.4% year over year.
Okay.
But if you adjust for inflation,
Right, to look at real purchasing power.
Right, exactly. Then they're actually down about 0.9% year over year.
Wow.
And both of those figures are below their historical averages,
Right.
as Charlie Bolello pointed out.
Mm-hmm.
And the report also suggests that some of that nominal increase
Right.
might be because of population growth from immigration.
Okay. More people, more
Yeah,
spending.
exactly. Even if individual purchasing power is declining. And the report draws this really stark contrast between the housing market
Mm-hmm.
and how home builder stocks have been doing.
Okay.
So annual sales of existing homes, single-family condos, co-ops,
Right.
they're down like 50% since 2018.
Wow.
So a pretty big slowdown
Right.
in transactions. But the U.S. Home Construction ETF, ITB,
Mm-hmm.
is up almost 200%
Wow.
over the same period.
That's a big divergence.
It is. And the report argues that this really shows the disconnect
Uh-huh.
between, the inflation-adjusted real economy
Right.
that most households are experiencing
Yeah.
and this kind of monetary, illusionary financial asset economy
Right.
that, wealthier asset owners are benefiting from.
Right. The idea that asset prices are going up, but it doesn't necessarily reflect real economic growth.
Exactly.
That's more of a monetary phenomenon.
Right. And they even suggest that this might be a symptom of, monetary inflation in the terminal phase of an investment mania.
Right, where prices become completely detached.
From reality.
Yeah. Okay, so given all these historical comparisons and this current divergence, what investment implications does the report draw?
Right. So it paints a pretty cautious picture, I think, overall,
Yeah.
when it comes to valuations of U.S. stocks.
Right.
And it points to several metrics suggesting that they're at historically high levels.
Mm-hmm.
And given this, contraction in the real economy
Right.
and this boom in asset prices,
Right.
their expectation is that this gap will eventually close.
Right.
And the way that'll probably happen is asset prices will go down
Mm-hmm.
in real inflation-adjusted terms.
Okay.
And they suggest that in this kind of environment,
Yep.
tangible assets like gold and precious metals
Uh-huh.
could potentially outperform traditional financial assets like stocks and bonds.
Right.
And it specifically highlights, those speculative favorites like
Yeah.
the FANG plus stocks and the Magnificent Seven
Right.
as being particularly vulnerable to big price declines.
Right, because they're the ones that have been bid up the most.
Exactly.
In this environment.
And they also advise caution when it comes to treasuries,
Right. Yeah.
except maybe as a short-term safe haven during like a big market sell-off.
Right.
And they're also a little bit worried about high-yield corporate bonds
Uh-huh.
because those spreads are really tight right now.
Right, which means there's not much room for error
Exactly.
if the economy weakens.
Yeah. But interestingly, they're actually pretty positive on emerging market equities.
Oh, interesting.
Yeah, they say that, they've underperformed for a while
Mm-hmm.
compared to developed markets.
Right.
And the valuations look more attractive.
Okay.
And they're seeing increased investor interest in that asset class.
Uh-huh.
They even highlight the views of Mark Galasiewski,
Right.
who sees potential breakouts in Asian and other emerging markets,
Interesting.
as well as in gold.
Wow.
And the author even mentions specific holdings,
Uh-huh.
in Hong Kong, China, property companies, conglomerates. Even some Thai and Indonesian stocks that have broken out recently.
Wow.
So they're seeing some real opportunities there.
Yeah, potentially rotation
Yeah.
away from the expensive U.S. market
What's
to
that
these
saying?
more undervalued international markets
Mm-hmm.
and into these tangible assets
Right.
that can provide a hedge
Yeah, against inflation.
and financial instability.
Now, they also get into the gold market a bit.
Oh, okay.
And they point out that, gold miners have actually underperformed
Uh-huh.
the price of gold bullion historically.
Interesting.
But they do note that physical gold has outperformed both the S&P 500 and the gold miners ETF GDX
Uh-huh.
since March of 2024.
Okay.
And they mention some specific breakouts in silver and platinum miners,
Okay.
like Majestic Silver AG
Right.
and Sibanye Stillwater SBSW.
Mm-hmm.
So they're seeing some potential upside there in the precious metals sector, including platinum.
Interesting.
And then they address this question, is gold expensive right now? And their conclusion is that it's reasonably priced compared to the real economy.
Mm-hmm.
But it still has a lot of long-term upside potential
Right.
when you compare it to the size and stability of the global financial system.
So it's kind of a balanced view.
It is.
It's gone up, but there's still more room to run.
Right.
Yeah.
Okay, so to kind of sum everything up,
Right.
this whole deep dive into these sources,
Uh-huh.
the key takeaway, I think, is that the Fed's rate cut is happening in this really complex environment.
Absolutely.
We've got high debt,
Right.
we've got high valuations,
Right.
and this big divergence between the markets
Right.
and the real economy.
Right. The markets seem to be living in a different world.
Exactly. And there are definitely some echoes of the past,
Yeah.
particularly that speculative fervor of the late 1920s.
Right.
But what's different this time
Uh-huh.
is that valuations are so much higher.
Right. We're starting from a much more precarious position.
Exactly.
Yeah.
And it reminds me of that quote that the report included from Ayn Rand's Atlas Shrugged.
Oh, yeah.
She wrote, "Whenever destroyers appear among men, they start by destroying money for money, is men's protection and the base of a moral existence."
Right.
So it's a pretty powerful statement,
It is.
and it makes you think about the broader implications of all these trends that we've been discussing.
Right. The consequences.
Exactly. So for our listeners out there,
Yeah.
the question I would leave you with is, given everything we've talked about,
Uh-huh.
what strategies do you think might make sense for you
Right.
as you navigate this potential future landscape?
Right.
Maybe it's worth revisiting these sources
Yeah.
and really digging in.
Right. And thinking about your own personal situation
Exactly.
and how these trends might impact you.
Thanks for joining us on this deep dive.
My pleasure.
We'll see you next time.
Take care.